Having a large pile of cash and not knowing what to do with it is a problem that some of us can only dream of. But it's an issue that many insurers are facing, and it's changing the industry. Hello, I'm Mark Dunne, AJ Bell's Head of Research. Welcome to the latest edition of Breaking the Mould, a regular look at the financial markets. Now, FTSE 100 member RSA has been in the news recently following speculation that the home and car insurer could be bought by Swiss outfit Zurich Insurance. RSA has more than 20 million customers around the globe, with UK, Canada, Ireland, Scandinavia and Latin America its core markets. Now, if you've never heard of the company before but have bought insurance from more than, then you're an RSA customer. It's its UK brand. RSA shares closed 18.4% higher at 518.5p on Wednesday, 28th of July, when Zurich confirmed it was considering making a bid. It appears that investors piled into the stock to claim any premium that a potential deal could offer. The size of any such premium, which is the price offered above the share's market value, is open to debate. One analyst at Panmure Gordon forecast that it could be as high as 29% to July 27th's closing price, which would value the potential deal at around £5.7 billion. Another analyst, meanwhile, expects a premium of between 10 and 20%, so we'll have to wait and see. The past 2 years haven't been great for RSA. An accounting scandal in Ireland led to 3 profit warnings, the CEO leaving the business, a £773 million rights issue, and the dividend being axed. RSA is firmly in turnaround mode, with costs being cut and non-core businesses sold to make the company smaller and more efficient. There are signs that the plan is working. RSA swung back into the black in 2014, although investors were disappointed that the reintroduced dividend was lower than expected. Could RSA's Scandinavian business prove attractive for a potential acquirer, with low competition and high profits in the region up for grabs? Now let's be clear. Zurich Insurance has not made a bid for RSA. It's responded to press speculation by stating that it is evaluating a possible offer for the company. Under takeover rules, it has to make a bid within 4 weeks, which is August the 25th, or walk away. If it walks, it cannot make a bid for another 6 months. This is not an isolated event. RSA is the latest insurer to be swept up in the M&A wave that has hit the industry. Other insurance takeovers in the past year include Canadian outfit Fairfax buying Brit Insurance for £1.2 billion and Aviva paying £5.6 billion for Friends Life. Driving M&A is the need to deploy excess capital. The problem is that insurers cannot put their cash to work profitably enough by writing new business because competition has eroded their pricing power, forcing premiums lower. Options that insurers have chosen when it comes to dealing with their surplus cash include declaring a special dividend. That's a payment on top of their regular shareholder return. FTSE 250 insurer Beazley recommended a 5.6% hike in its regular dividend in 2014, alongside an 11.8p a share special dividend. The additional payment was made despite pre-tax profits falling 26% that year. The second option is to buy another company. Now, there are 3 factors driving M&A in the insurance sector. 1, as we've heard, companies are looking for an alternative to writing new business that will provide higher returns. 2, low interest rates mean companies can raise cheap debt. And 3, the introduction of new European rules on how much cash insurers must keep in reserve to protect against market shocks means that some insurers need to strengthen their capital bases. Remember, you don't buy a share just because you think it will be sold for a juicy premium or just to collect its special dividend. The share price automatically adjusts by the amount returned to shareholders on the ex-dividend date. So, if you don't believe that the price will rise, then you could lose money. Thank you for your time, and I'll see you next week.